We have well over now 40 million downloads. We have 15 offices with 13 operating broker-dealers. We transact in any given day probably north of $2 to $2.5 billion of equity. That's probably north of 300 million shares per day, every day. On a trading floor, things happen quickly. It's fast motion. There's a lot of money involved. There's a very high stress environment. You can't take the time to describe tiny nuance in a conversation. We didn't have the marketing, the advertising spend, or the reach to announce to the world that you could be involved in the U.S. capital market system without having to pay a broker commission. Fidelity and Charles Schwab, they did it for us, right? They did the Super Bowl commercials. They put the NBA Finals commercials out there. They paid for it, and they told everyone in this country that you can now be an investor.
Hello, everyone, and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza, and I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the U.S. and Latin America. If you enjoyed this conversation, I invite you to leave a review on Apple Podcasts or Spotify so more people can learn about fintech leaders. In this episode, I sit down with Anthony Denier, Group President of Webull Corporation, a global digital investment platform serving 20 million users in over a dozen countries worldwide. We discuss what it takes to be a great trader on and off the trading floor, how technology, client demands, and regulation transformed the trading industry over the last 2 decades, why Webull decided to expand beyond the US, making a big push in places like Latin America and Asia, Webull's plan to go public via a $7 billion SPAC, and a lot more. Anthony, welcome to Fintech Leaders, all the way from, I assume, downtown Manhattan.
Yes, sir. 44 Wall Street, right down the block from New York Stock Exchange.
Amazing. Right where it all started for our modern era of investing. You're just a few blocks from, was the New York Stock Exchange the first exchange in the world for stocks?
No. The London Stock Exchange, I believe, was the first operating exchange for equity or shares of equality in terms of company ownership.
Got it. But these days I talk to founders and I talk to CEOs of publicly traded companies that are not homegrown in the US, but that were built all over the world. And they tell me they don't want to list in London. They want to list in the US, in New York. It seems to be by far the premier destination for tech listings. Is that also what you're seeing?
Now, the US capital markets is by far the deepest, the most robust, the greatest magnet of capital in the world, not only today, but probably safe to say for the last 45 or 50 years. So absolutely, companies, whether they exist in the United States, they operate, they get their profitability outside, they have zero personnel in the US, they all want to have their capital creation and their ability to raise capital based in the United States.
Yeah. I recently interviewed actually on the NASDAQ studios on the floor of the NASDAQ, the CEO and co-founder of Kaspi, which is a company that was listed in London for 3 years. And then they said, you know what, this is not good enough. We're going across the pond. And now they're very happy with the US. But Anthony, I digress. Let's talk a bit about you. I want to hear about your first investment, and hopefully I can take you all the way back, but do you remember what was your very first investment?
No, you're going to embarrass me because I do remember my first investment because it was a complete disaster. It was probably my junior year at college. My grandfather had given me a couple $1,000s to invest. And at the time, E-Trade was around. This is in the 90s. E-Trade had just opened a few years before. I love the idea of being able to open up an account through a website at the time that was extremely new and novel and interesting to someone that was young like myself and interested in the financial markets. And I was obviously full on the .com craze, like everyone else was. And there was a company called EMC, if you recall. I was a data storage company. And I think I was right on that ahead of the cloud. But the whole idea was data and storage and the ability to do it in mass and scale for large corporations. Long story short, I definitely got in at the top. And the performance of EMC went nothing but downhill. The thesis was right if I had enough buying power to stay with it for the long term, but unfortunately my buying power was finite and I ended up taking quite a hit on that. But it was a good lesson learned nonetheless.
What did you tell your family, your grandfather? Did you share or you stayed quiet?
Oh, I stayed quiet until he asked about his money. It wasn't a good response. But again, I think the contribution was made for the experience rather than the retirement income.
So if your first investment was short-lived or did not go according to your expectations, what made you continue to pursue a career in stocks and investing? Because you do hear of people whose first investment is not a good one. They say, hey, this is not for me. I'm going in a different direction.
Mm-hmm. Yeah, no, I mean, finance is not for everyone, especially investing. There's a lot of emotions and a lot of risk that comes with it. But every day presents a new set of information, a new set of kind of almost tools to build upon. And that was something that always intrigued me, that every day was a new day to feel what's going on in the world, what's specifically going on in the macro and micro market in terms of the economic cycle. And that's something that always was attractive, where I could show up to work in an environment where every day was going to be different from the last. And that was something that I was scared of coming out of college, that I would be stuck in something monotonous. And the last thing I wanted was monotonous. And so I worked on a trading desk right out of school, and it was anything but, where every day had its ups and downs and emotions were usually multiplied by what they should have been.
Did you consider just staying on a trading floor? Because that is a career option, right? And I know you did it for a while, but eventually you pursued a more entrepreneurial route. What convinced you to get out of the trading floor?
Well, we had a quick conversation prior to starting this. And one of the things I mentioned is that I'm definitely not someone that failed upwards, but my experience on the trading floor was not a string of successes one after another, whether it was choosing the wrong team, the wrong firm, the wrong product, or even the wrong timing. I always felt like being on a trading desk, especially in the institutional side of the world, was something that was constantly contracting around me. Not only were margins being compressed every day, where customers were demanding more while demanding to pay less, you had the separation of research, investment banking, and the trading fees that were paid by the clients. I used to be when I first started, it was kind of one large pool where they would pay the trading desk and commissions for maybe the research they would receive from the research team. Well, that started getting bifurcated very early in my career. And it not only became harder to have successful relationships with our clients, but it became harder to even monetize the ones that were successful. So I would say from probably the first or second year to me starting on the trading desk to now fast forward 15 years later, the profit margins went probably squeezed by 80 to 85% over the course of that time, where, to give you like illustrative example, when I first started on the trading desk, the year was 2000, and there were approximately 300 traders on the trading floor that I was on. I worked at a firm called Credit Suisse, which no longer exists. UBS bought them recently after some ugly moves that Credit Suisse had made, but there are about 300 traders on the floor. I would say today, even at UBS, and don't quote me on this number, someone UBS may be listening to this and say I got it wrong, but it's a fraction of that number now.
Is that 100% driven by technology, or is there something else at work?
It's definitely a combination of many things. Technology is probably one of the leading components. In fact, probably about 4 years into my career, when we first started seeing a lot of the margins compress in terms of what clients wanted from their counterparts on an institutional trading desk, was the lack of high touch interaction, right? They preferred an instant message as opposed to a phone call. That was the stage one. And then fast forward, we started offering electronic trading services to our clients opposed to personalized telephone trading services, right? So commissions were being paid less by the buy-side clients, which they liked. And now we use this new technology at the time called algorithmic trading, where the buy-side traders can get a very similar outcome, whether they wanted a VWAP trade, meaning a volume-weighted average price over the course of the day, whether I could do it myself manually, which had been the case prior, or have one of my position traders work it out through the day, or now it was as easy as point and click, and they could basically have a near guaranteed VWAP price for a fraction of the commission without having to deal with speaking to someone in person. And if you're a buy-side client, it made sense. If you're talking to 15 different investment banks, you have 15 different traders like me calling you up all day, it gets busy and noisy, especially when some are more important than others, and it's hard to kind of triage that. But if you can electronically send your orders out, which we were doing more and more, it just became a technological solution for the industry to no longer need an institutional trader like myself to handhold a buy-side trader through the day on their order flow. We had a combination of shrinking margins, regulation in terms of separation of how customers were allowed to pay for the services they received from the firm in totality, as well as the ability for now customers to interact with a machine instead of a human at a much cheaper cost.
Yeah, I've been to the floor of the New York Stock Exchange a couple times this year, and it's quiet. It's very respectful and quiet.
Mm-hmm. I have a lot of friends at the New York Stock Exchange. We have a great relationship. But sometimes you walk through the floor of the exchange and you remember the days when people are yelling and screaming and you see all the pictures, or you remember the old movies. It's no longer like that. It's a bunch of beeps and whistles from the machines all talking to one another.
Let me ask you this, Anthony, from your experience back on the institutional trading floor, right? Back in the, let's call it the first leg of your career. From your point of view, what made a successful trader, right? Well, what did they have in common? And I think you've kind of mentioned a few things already, but I'm curious, those that you looked up the most and admire, what did they have?
Well, I mean, number one is the interpersonal skill. That's really important, to be able to empathize with what the person on the other phone wants to do and being able to recognize that quickly. And then also something that gets overseen a lot is the ability to take something that may seemingly be complicated and easily explain or describe what's going on in a short, distinct, and very concise manner, where the customer or even someone internally, that you're speaking to on your own trading floor can understand and grasp quickly. On a trading floor, things happen quickly. It's fast motion. There's a lot of money involved. There's a very high stress environment. You can't take the time to describe tiny nuance in a conversation. So the ability to kind of compress all the little differences and subtleties and be able to explain that in a short, concise, direct manner, I think is probably one of the two most important parts of being a successful trader, or at least it used to be back when people wanted to talk to traders.
And so at some point, you ditch that life and you join the startup world. So why Webull? Maybe take us to the beginning of that journey.
Sure. Yeah, happily. So towards probably the twilight of my trading career, I decided to make a pivot and go into administration and management. That being said, I took a lot of licenses and exams, became registered as a principal, became registered in other parts of the firm that enabled me to have more of a managerial scope of work. And I became CEO of, at the time, it no longer is in existence, but at the time, a small UK-based broker-dealer called LXL. I opened up the New York office of this firm as CEO, This was a small distressed debt and institutional equity broker-dealer. I started from zero, literally going through the FINRA account opening or new member process, getting the license from FINRA, which is the U.S. regulatory body that grants a broker-dealer license in the U.S., to literally putting together trading desks and hiring, putting in phone systems, getting the accounting system all in place. I was HR, I was CEO, I was CCO, I was COO. We had a small team in New York, probably maxed out at about 5 or 6 people, mainly institutional traders, salespeople. And we built a small and sustainable business in over about 4.5 to 5 years. And that's when an opportunity came across my desk to do something radically different. And kind of in my head at the time, just like when I started, there was a continuation of margin compression in the institutional world. Even though we're still doing enough business to keep the lights on, every month over month, it seemed like growth got harder to achieve by basically going through the same processes over and over again. It became less valuable to our clientele, and that was noticeable to me. I was introduced to Webull through one of the consultants that I had at LXM, who said, Anthony, there is a person that has a market data app. This market data app apparently is quite popular. I've never heard of it before. He gave me the name. It's called Webull. I downloaded it. I looked at it. I said, wow, it looks kind of like a Bloomberg, actually. And he's like, this is for retail. He's like, yeah. I said, okay, I'd like to meet this person. This person is the founder of Webull, which is Anquan Wang, my boss. And he came to New York several times. We sat down several times, had conversations about visions of what he wanted to do in terms of building a brokerage platform based on a more advanced kind of interface through a mobile device for retail customers. And coming from an institutional background, all I knew was the advantages that institutions had over retail, right? Just inherently just in information flow, data, just getting real-time information, better data, just makes you smarter and faster in the decisions you make in intraday trading. So I was all in at that point. It was by far one of the best products I've ever seen on a mobile app. And at the time, I was a customer of all the large broker dealers, all the kind of online legacy broker dealers, and some, not all of them, had mobile apps. But mobile apps at the time, so I'm talking 2016, this was, mobile apps were like a slave to the website. You can maybe check a balance. Maybe you can watch your portfolio in near real time, maybe with a slight delay. Some of them didn't even offer the ability to transact or trade or deposit or withdraw from the app. It was just an ability to say that you actually had an app at that point. The functionality was minimum and bare bones. And when we started getting more into the strategy of how we could build a competitive retail platform in one of the most competitive spaces in the world, it was very, very clear that we had an advantage. We had a better product, number one, and we both had the belief that people are going to start investing on their phones. And at the time, we're talking 2016, that was not the expectation of the general public. Most people said, if investment is very serious, I need to be in front of my computer. I need to have multiple screens. Like, this is serious business. The phone is for getting a Uber. The phone is for ordering pizza and maybe swiping right on someone I thought was good looking. Like, it's not for investing. And there was a startup that had started making some waves while I was making the decision to join Webull, a small firm, you may have heard of them, called Robinhood. And again, never heard of Robinhood prior to 2016. They were just starting off, and they were doing it in a way that was very opposite than I was used to. They were simplifying the process, making it very, very easy to get access. They called it democratization, which I think obviously is a great business model. And I saw what they were doing, and they looked like they were disrupting. And as soon as you see a disruptive force and you see a product that is definitely best in class, I was all in at that point. And that's when I signed and said, I want to be part of this. That's when I became CEO of Webull.
Now, You mentioned Robinhood. Over the last, call it 4 years, I've had the opportunity to interview the leaders of most of these firms in the US, Public, Robinhood, Stash. There's a few more, right? The thing is, though, they're a little bit different in the sense that you're offering pretty much like a comprehensive set. You have access to options, you have access to ETFs, and a lot more products that are quote unquote sophisticated, right? And at the same time, your customers, 75%, correct me if I'm wrong, but 75%, they're not your average retail trader. They go a step beyond. So what came first, the focus on the more sophisticated trader or building the products and then the customers came after that?
So the products came in stages, but the realization that there was a real marketing opportunity, right? People talk about TAM, and you try to figure out the right place where you want to build your business in the right space. And we had the perfect, or at the time, and timing is everything, I can get to that, but we had the right timing and we had the perfect product to not only disrupt the sophisticated customers that were used to trading on platforms like Power E-Trade or Thinkorswim or Merrill Edge at the time, but were not happy paying $4.99, $9.99 a trade. At the same time, we had customers that were really enjoying the Robinhood product, but now had been using Robinhood for a certain amount of time and almost graduated past the simplicity where they wanted more. They wanted more functionality. They wanted the ability to trade in true extended hours, to be able to short shares, to be able to get 4 times day trade buying power, all the things that a more sophisticated retail trader would demand. So we sat in a really good spot where we took the customers from the legacy platforms like the E-Trade Pros, like I mentioned, the Thinkorswims that were tired of paying commission. So they were coming to Webull for the zero commission. And then you had the clients on the other side that were leaving firms like Robinhood that loved the zero commission, but didn't like the lack of tools. And they were coming to us for the sophistication. So we sat in that really powerful kind of middle ground from our launch in 2018, probably till I would say the end of zero commission in November of 2019, when all the broker dealers went to zero commission in the US.
So you say timing is everything. So in a way, those initial wave of E-Trade and then I guess what Robinhood started doing, those paved the way for Webull to come in the middle. Is that what you're saying? So a little bit earlier, you probably could not have launched with the same momentum.
That's exactly right. You have firms like Thinkorswim that paved the path for sophisticated retail self-directed traders. And then on the other end, you have firms like Robinhood that blazed the trail on zero commission, right? So we kind of came in with both best of breed ideas, right? Have a sophisticated, highly analytical platform, also offer it for zero commission. And then to hit on timing is everything. November 2019, all U.S. retail broker dealers, essentially, one after the other, all went to zero commission. Now, definitely a moment of reflection, I think internally here for us at Webull, where we kind of looked at each other and said, well, that was fun. Like that was a good ride we had from 2018 to basically the last 2 years to the end of 2019. But it was the realization that for the last 25 years, the retail brokerage industry has been fighting over a finite pool of clients. And now for the first time in 25 years, that pool expanded by a factor of probably 2 to 3x, right? So now there were just more people out there that because Robinhood, Webull, all included, all the zero commission platforms that were out there, we didn't have the marketing, the advertising spend, or the reach to announce to the world that you could be involved in the U.S. capital market system without having to pay a broker commission. Fidelity and Charles Schwab, they did it for us, right? They did the Super Bowl commercials. They put the NBA Finals commercials out there. They paid for it. And they told everyone in this country that you can now be an investor without having to pay a broker commission. And firms like Webull, firms like Robinhood were the beneficiaries of that. Now, granted, they have the saying, the high tide lifts all ships. Certainly the case. Everyone saw a huge increase of new account growth and a kind of a resurgence of the retail investor that hasn't been seen since the late 90s, with E-Trade being one of the first to do it well online. But the timing just kept kind of playing to our strengths over that course. And through that period, you asked about products. We had been adding products through the timeline of seeing us get this nice, strong base of users from our launch in 2018 to zero commission at the end of 2019. So we had a nice sustainable base. We had good word of mouth going around about what we were offering and the products we were offering as we continued to offer new products that customers were demanding. And then we got hit with a whole bunch of tailwinds that just struck us in a way that I don't think anyone in the industry could have forecasted. And I'm obviously talking about the pandemic and stimulus checks, a raging bull market, a Fed backstop. I mean, there were so many tailwinds that were helping retail broker dealers basically put new clients onto a platform because they, for lack of a better word, like they had more time, they had less noise in their life, and they could focus like, hey, I'm going to use this opportunity to make myself better financially. It certainly paid off. And you see how all of the retail platforms have expanded in scope that we've never had before, where it's rare to see someone that is not familiar with a retail trading platform nowadays. That was not the case when I was growing up. When I was younger, it was always something for the wealthy to have investments in. And then that's completely changed. And now through the ability for information to be shared, the ability to access, and ability of extremely low cost and low barriers, anyone can be an investor and everyone can help themselves become better at investing, which is obviously one of the life skills that unfortunately we don't teach well enough in our education system.
On that point, Anthony, does being a sophisticated investor, is sophisticated investor synonymous with just higher AUM? Or what does it actually mean?
No, absolutely not. I think that is a misconception that the more money someone has, the smarter they must be. But I find that to be sometimes the opposite. Now, granted, if you have more AUM, you tend to have more focus on your finances. That's a truth. But you can't define customer sophistication by the balance of their brokerage account, because you see, especially young people that spend a significant amount of time spending time educating themselves, going through educational tutorials that we have on our platform, reading different learning materials we put on. And those are the ones that go to the next step in terms of becoming a investor that wants to go along with the crowd. And I'm not saying that anything wrong with following social media to decide which investments you're going to make is wrong, but being able to come up with an investment thesis on your own is something that I think is really important for the long-term stability of someone's financial success. And sometimes that starts with having just $100 in their account.
Now, when you are talking about investors and your customers, you're not just talking about US investors. You have global ambitions and operations. You have over a dozen licenses, right? Why go global, right? Why not? The US market is huge. Why expand?
Well, I mean, first off, you can always be bigger, number one. And why go global? So I think as the world, unfortunately, continues to de-globalize on a lot of different levels and for many different reasons, which we certainly don't have time to talk about here, but the investor is actually becoming more globalized, right? We are seeing investors on the other side of the planet, Southeast Asia, Australia, looking at how to invest in the US. Names like Microsoft are ubiquitous globally, right? Names like NVIDIA is now ubiquitous globally. Doesn't matter where you are, you're using their products. You want to be an investor in companies that are succeeding and growing, right? Year over year consistently. So like we started this podcast off, the US still remains to be the most attractive place for investment. And if Webull can offer the opportunity for people outside of the US to invest in US securities, we want to do the best job we can at doing that. So as of today, we have 13 operating broker-dealers globally. All of them operate completely independently from one another, and all of them, with the exception of one, pending, have the opportunity for their customers to trade U.S. equity, even though they are non-U.S. citizens and members or customers of a non-U.S. broker-dealer.
One of those regions is Latin America, of course, and our good friend Ruben is the one who actually put us in touch, who's leading your LATAM team.
Yep, shout out to Ruben.
Yeah, shout out to Ruben. What has been your experience kind of launching the Latin American operation, and then why is this attractive versus other ones?
Latin America is unique, especially when we talk about Brazil as part of Latin America, where huge population, upward mobility of the population. You're seeing a huge middle class form in Brazil. The wealth kind of transition and creation in Brazil is something that Webull as a firm wants to be a part of that rising tide. There's so much opportunity there. You're seeing a much more friendly regime in terms of foreign brokerage firms coming into Brazil, where talk to me 5, even 3 years ago, it seemed a lot more restrictive in terms of allowing non-Brazilian firms to do business in Brazil. So we're seeing that start to lift. We want to be first to market, or one of the first firms to market there, which gives us obviously a nice head start. So we're really excited to get involved in Brazil. Also, at the same time, Mexico is another story where we purchased a fintech firm called Flake in Mexico. And Mexico, again, huge population, growing wealth creation, growing middle class. They want access to U.S. capital markets. There's also something in Latin America that they call northbound money. I don't know if many of your listeners are familiar with this, but basically northbound money is citizens with capital that are based in Latin American countries. Doesn't have to be Brazil, Mexico specifically. It could be pretty much all of them. They look for many different ways, and there are a lot of mechanisms to move their money into the U.S. banking system and hold their money in U.S. dollar. It gives them some safety and security relative to maybe what they may experience in their own country. It also gives them a little more stability on inflation. We think that we have inflation pretty bad here in the U.S., but historically, our inflation has been one of the most stable globally, especially when we compare it to Latin American inflation. So there's a lot of opportunity to offer a really unique and exciting product for our customers down in Latin America. So Brazil and Mexico were our first 2 entry points, and we hope to expand further down there.
If I talk to you in 5 years and we're talking about your global expansion, what would be a success? What would you be telling me if you were successful?
5 years from now, I would ring the success bell if I could tell you that every single customer of a Webull brokerage affiliate around the world is able to trade in a security that exists in every Webull affiliate. Meaning, if I have a customer that's a client of our Webull United Kingdom broker-dealer, they can not only trade U.S. and obviously U.K. securities, but they can trade Brazilian, Australian, Hong Kong, Singapore, Malaysian, Indonesia, Philippines, Thailand. I could go on and on. That would be my goal. That's kind of the holistic solution for a global retail client. And I mentioned that the retail client is a global client. That would be a really cool thing for me to be able to say in 5 years.
Another thing that you are working on, Anthony, and I think this is interesting to talk about, you yourself, Webull, you're becoming a publicly traded company, right? And so we should talk about that. And I'm especially curious as to why you are doing it. Why are you doing it by the SPAC route, right? I think with a published market cap of north of 7 billion. So take us through your decision that got you to this result.
Well, first, I think SPACs get a bad representation a lot of times because at the end of the day, SPAC is just one method of getting to public market. The traditional way of having an investment banker and a group of possible investors dictate your valuation is the most common way. And the market in which we are involved in right now is a difficult market for traditional IPOs, meaning the appetite for traditional IPOs is extremely limited. And I would even double that, would say it's extremely limited for fintech at this point. So we looked at our options, and we've also had some history with the traditional IPO route where there were certain limitations on us to be able to, let's say, go past the comments of the regulators of the SEC because of certain business lines, right? So we used to offer cryptocurrency on our platform. We no longer offer cryptocurrency on our platform, specifically because of the U.S. regulators, let's put it politically correct, the U.S. regulators' non-optimistic view on that sector of the economy, right? And because we did have exposure to cryptocurrency and we offered cryptocurrency to our customers, we were not allowed, well, that's not true. They did not specifically say we were not allowed, but we weren't getting past the comment period with the regulators, right? And that stretched for a very long period of time. We have since shed all of our cryptocurrency exposure, and we decided this time around that we were going to have more control over the process. And going public via SPAC gives us that control, where not only can we agree on a valuation at the beginning of the process and then let investors decide at the end whether that's an appropriate valuation, we can also have more control over the time frame and the timeline that we have with managing the investor expectations, road showing, et cetera, and not having the decision making of us being able to go public put in the hands of several investment bankers and several large institutional investors.
I don't need to tell you this, you know this better than anyone, but SPACs have this stigma that in many cases it doesn't make sense. In other cases, it's deservedly so. It sounds like that doesn't have you concerned because you are actually profitable. I guess we're going to see your full numbers soon. But why is this not a concern for you?
Oh, it's not a concern because we have a mature business. We're a global business. We are a consumer-facing business. So if you go in on Main Street and you say, hey, have you ever heard of Webull? 90% of the people say absolutely not. However, people in the space have heard of us. So we do have a reputation within investors. So we're not some esoteric kind of B2B to B2B company behind the scenes. We do have 2 straight years of profitability. And we have a very mature product line as well as very extensive and large customer base. And, if your listeners probably know, financial user bases tend to be the most sticky of all customer bases, right? If you take a technology platform, you can use so many, but I'll use obvious ones. Like people, you could see just kind of the zeitgeist of the world go from MySpace to Facebook to Instagram to Snapchat. It just keeps changing, right? Like the waves keep changing as to what's popular. Meanwhile, on the financial side, which obviously is the world that we live in, I mean, you could be mad at your bank for the last 10 years and you still hasn't closed the account. It's just a much stickier experience. So the business is a lot heavier. And so we're confident that when we do release our numbers and we show kind of how big we actually are, how many transactions we do regularly every day, I think people will stop caring about the idea that, oh, they're going public via SPAC, and to be like, okay, how do I own some and what's the right valuation here? I mean, if you look at some of the companies before us that went SPAC, SoFi is a good example, right? SoFi went SPAC and their performance after the SPAC may have not been very good, bad timing, right, in terms of the market, but they've been coming back as well. And obviously you see the change in Robinhood stock price, right? It's something that obviously I watch pretty closely, where you have the traditional IPO method valued Robinhood at a certain level. It had that immediate euphoric pop after it priced, and then it was trading, below $10 for almost a year and a half post IPO at 35. So, obviously they've been doing a lot of good things there. So I want to commend them on turning the business around and reaching a level of profitability. And now you're starting to see them creep back close to their initial IPO price. So again, like the SPAC gives us just more control in that process. And we're very confident in the maturity and the substance of our business that investors will realize that too.
Are there any numbers that you can share to kind of help us understand the magnitude of the business?
In terms of kind of revenue, I'm still going to wait until we close out our first half of this year, and we'll come out a bit more publicly with that. But, in terms of like scale, we have well over now 40 million downloads. We have 15 offices with 13 operating broker dealers. We transact in any given day probably north of $2 to $2.5 billion of equity. That's probably north of 300 million shares per day, every day. We have one of the largest market shares in options trading in the United States in terms of retail platforms. I believe we're probably ranked number 5 in terms of market share, trading on average about 2 million options contracts per day. So these are substantial numbers for a retail brokerage platform, notwithstanding one that's only been around, only been open for dealing for 6 years.
One community in your world that has become extremely popular is Wall Street Bets.
Mm-hmm.
Are you a frequent visitor of Wall Street Bets?
I am not, but I am aware of it.
Yeah, some interesting things coming out of there.
Oh, yeah.
And so let me ask you this. When the market turned in 2022, why were you ready to deal with the market turning? How was 2022 internally? How did you live it?
I want to phrase this correctly because I know I may have some of my competitors that listen to this, but we were uniquely positioned. And I want to say uniquely because we already had started to expand internationally where we weren't just dependent on a US customer base. So we did have a much broader diversification of clientele, number one. Number two, our product development was already kind of in its maturation stage where we already had a good full suite of options products, equity products, the ability for customers to do more with equity products, i.e. shorting stock, right? And so in a very bear market, when you give the customer the ability to short stock, which a lot of our competitors did not have the ability to do, whether by design or by limitations of just functionality, there's multiple revenue streams from just that one product line. Not only is a customer going to have to pay to borrow the stock that they're selling to someone who wants to buy it, they're going to have to pay margin fees because technically that is a marginable trade. And then obviously you have the commission built in our case, the payment for order flow. So there were 3 prongs of revenue just from our one product of being able to short stock. So that was also, I think, number 2, a really key factor for us through that kind of downturn. And third, probably the most important, is going back to our customer type, a more sophisticated, less fair weather type of customer, right? So because our customers were more sophisticated, they understand that markets do not always go up. So they tend to be a lot more active and they tend to play the volatility of a down market, right? Not only with the ability to short, but the ability to dollar cost average down on positions and just have a little more experience in terms of dealing with a tape that is going in the wrong direction. Those 3 combined, I think, was probably our best representation of why we were able to remain somewhat flat. And I would say from the peak in terms of customer activity, in terms of probably top line revenue and profitability as well, probably happened around November or December of 2021. And then from 22 all the way from probably November of 23, it was pretty much a straight line down in terms of new customer acquisition, higher customer acquisition costs, lower ARPU numbers. But because of those 1, 2, 3 things I mentioned, we were able to maintain a very, very steady revenue stream throughout that 18-month period of famine, as I guess you would kind of describe it.
Anthony, 2 more questions before I let you go, and they're both related to your background right now. I see a printed newspaper, actually a framed story. And anything in particular happened that day?
Oh yeah, that's an ego thing. That is a very small newspaper. It's the Pittsburgh Post-Gazette. And I am not in Pittsburgh, obviously. I'm not from Pittsburgh, so it doesn't have sentimental value. But it's the first time that I was quoted in a newspaper article since starting Webull. And that was back in December of 2019. And it was a story where a reporter was asking me if there was going to be a Santa Claus rally in 2019. So I framed that because it was the first time I saw my name up in lights. It was pretty cool.
Very nice. From that to, I guess, this podcast. So congrats.
Yep.
And finally, behind you, I see a few books. If you had to gift one of those, because it's the best, not because it's the one you want to get rid of, which one would it be?
So I do have a bunch of books behind me, but I'm going to admit something. I have not read them all because I just don't have time. So I know you end your podcast by asking your guest, if you could recommend a book, what would you recommend? And I actually thought about this. I could mention a book that I maybe read 5 years ago on the beach somewhere, but when I do that, I do it for fun. I read all day, every day. I don't know how any of your guests have the time to read a self-help or a kind of market-related or fintech-related book. I don't see that. I mean, I wish there was more time in the day, but there's not. But what I would say is that there's several podcasts they should listen to. I commute into the city most days a week. I have about an hour where I'm banging out emails in each direction and listening to a podcast during. That's kind of where I get a lot of my information. I like to keep a lot of the things bipartisan, so I'll listen to Breaking Points. Don't know if you know that podcast. I listened to this great one by this guy with a Spanish accent called Fintech Leaders, which is also a really great one. That plug is free. And if anyone interesting is on Rogan, I'll probably listen to that one too, get at least an hour in before I get bored. But yeah, I wish I could tell you that the book's behind me. I've read them all, but I haven't.
I love the honesty and the plug. Thank you. So Anthony, thanks for doing this. Thanks for taking time out of your busy day, especially during the market close. It just closed a minute ago. I know that gets especially busy around your office.
It's going to get rowdy. Yeah. Any second. I think it's almost about to close right now.
Well, thank you so much. And I'm going to be eagerly watching and waiting for those numbers and following Webull very closely.
Yeah. I look forward to releasing them, and I'm excited about taking Webull public and taking our next step in the evolution of this business that we've all worked so hard to grow.
Thanks for tuning in. I hope you enjoyed this great episode with Anthony Denier from Webull. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and means a lot. If you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza. The Fintech Leaders podcast is for informational purposes only and should not be considered financial or investment advice.